Hey everyone, and welcome. If you're doing business in Saudi Arabia, you know that VAT can feel, well, a little complicated, but getting it right is absolutely crucial. So today, we're going to break it all down. We're turning those complex regulations into a super practical guide to calculating and invoicing for VAT.
So let's just dive right in with the million-dollar question, right? When it's time to file that return, how do you actually figure out your net tax? On the surface, it looks pretty simple, but trust me, the details are where it really counts.
So here's our game plan. We'll start with the basic formula, then get into some of those special cases that pop up. After that, we'll talk about what you can, and just as importantly, what you can't claim back. And we'll wrap it all up with the paperwork. Think of it as your roadmap to getting VAT right.
Okay, Section 1. Let's start at the very beginning, with the one formula that is the foundation for absolutely everything else. If you get this, you're already halfway there.
When you boil it all down, it's just a simple piece of math. Your net tax payable is the total VAT you've charged your customers. We call that your output tax. And from that, you subtract the total deductible VAT you've paid to your suppliers. That's your input tax. Simple, right? This is the default method, and it's known as the invoice accounting basis. Now, here's where it gets interesting, because timing is everything. With the default invoice basis, you have to account for VAT the second an invoice goes out the door. Doesn't matter if you've been paid yet. But there's another way, the cash basis. With this, you only deal with the VAT when cash actually hits your bank account. It can be a real game changer for cash flow, but it's not for everyone. And here is the magic number, 5 million Saudi riyals. To even be considered for that cash accounting method, your annual taxable sales have to be under this amount. It's a clear line in the sand, and it's really designed to help out smaller businesses.
But it's not just about the revenue. There are a couple of other things to keep in mind. You're out if you've had a VAT violation in the last 12 months. And this is the big one. You have to get specific, explicit approval from the tax authority to use this method. It's an option you have to apply for, not something you can just choose to do.
Okay, with those basics covered, let's get into some of the more unique situations. We're going to look at two special cases that have their own set of rules: selling used goods and buying services from suppliers who aren't in the country. Now, this is a really cool one, especially if you're in the business of selling secondhand items. It's called the profit margin method. Instead of charging VAT on the full price of an item, you only have to calculate it on your profit. It's a perfect example of how the VAT system can be flexible.
And the calculation? It's super straightforward. You take your selling price, subtract whatever you paid for the item in the first place, and that difference, your profit, that's the number you apply VAT to. It's that easy. And get this, if you break even or take a loss on the sale, your VAT for that transaction is zero.
All right, you're going to want to listen closely to this next part, especially if you work with international suppliers. If your business here in Saudi Arabia gets services from a company that isn't a resident, the responsibility for the tax completely flips. You, the customer, are the one who has to calculate and pay the VAT. This is called the reverse charge mechanism, and it's something you absolutely have to get right on your tax return.
Okay, now for the part everybody likes to talk about, getting your money back. This is all about understanding exactly which taxes you've paid that you can deduct. This is how you shrink your final VAT bill, so let's get into it.
So, as a general rule, you can deduct the VAT on pretty much any goods or services you buy for your business, and that includes imports. But here's a great little tip. You can even claim VAT on services you bought up to 6 months before you were even registered. Now, the golden rule through all of this: you must have a valid tax invoice for every single thing you claim. No invoice, no deduction.
But what about things that are shared expenses? Like your office rent, which might support both your regular taxable sales and maybe some exempt activities you do. Well, you can't claim 100% of that input tax. You have to use a special formula to figure out the proportion. You just take the value of your taxable sales and divide it by your total sales. That percentage is how much of the VAT on that shared cost you can claim back.
Now for big-ticket items, what the rules call capital assets, things get a little more long-term. We're talking about a new delivery truck or maybe even an office building. For these, you have to keep track of how you use them for a long time, 6 years for movable things and 10 years for property. If the way you use it changes over that time, say it goes from 100% business use to only 50%, you have to go back and adjust the input tax you originally claimed.
All right, we've talked a lot about what you can claim. Let's flip the coin. It's just as important to know what is specifically off-limits. These are the expenses where you are flat out not allowed to deduct the input tax.
And the rules here are crystal clear. Any VAT you pay on entertainment, on catering in places like hotels or restaurants, or on stuff you buy for your personal use is non-deductible, period. And you see that one there? Restricted motor vehicles. This one trips up a lot of people, so let's define exactly what that means.
The key word, the only word that matters here, is exclusively. If a company car is available for an employee to use for private reasons, even just driving it home on the weekends, it's immediately considered a restricted motor vehicle. And that means you cannot deduct the VAT on the purchase, the fuel, the repairs, nothing. It has to be 100% for work, zero exceptions.
Okay, we're in the home stretch. You've done the math, you've figured out your deductions, now you have to create the paper trail to prove it all. This is all about dotting your I's and crossing your T's to stay compliant.
So, there are two main types of invoices you'll use. The full tax invoice is what you use for B2B transactions, and it needs a lot more detail, like your customer's tax ID. The simplified tax invoice is for when you're selling directly to a person, and it's, well, simpler. This little checklist here is a great guide for what you need on each one.
And whatever you do not forget the deadline. This isn't just a suggestion, it is a hard and fast rule. You have until the 15th of the next month to issue your invoice. If you're late, you could be looking at penalties, so getting those invoices out on time is absolutely essential.
But hey, people make mistakes, right? So what happens if you get an invoice wrong? Don't worry, there are official tools to fix it. If you charge too much VAT, you issue a credit note. If you didn't charge enough, you issue a debit note. These are the proper, official ways to correct an invoice after it's already been sent.
So, there you have it. We've gone through the core formula, the special cases, what you can and can't deduct, and the paperwork. The real question for you now is which one of these rules is going to have the biggest impact on how you run your business? Is it those super strict rules on company cars, or maybe that profit margin method? Thinking about that is your first step toward getting this right every single time. Thanks so much for joining me.